This Chapter 1 summarizes the philosophy behind Basel III and its application to a bank's capital structure from the qualitative and quantitative perspective. We first list some of the main objectives of Basel III in summary fashion, and later describe the most important of these in greater detail. First, a need to increase the amount and quality of bank capital and ensure that this capital truly possesses the characteristics of loss absorbency, which roughly means that the capital will absorb losses before bondholders and other more senior capital providers. Second, a lower tolerance for so-called hybrid securities, deemed to have failed to perform as expected during the financial crisis. In this regard, various forms of hybrid securities, referred to as contingent capital, are being carefully scrutinized by issuers and investors to determine their eligibility under Basel III. Third, a need to introduce a US-style leverage ratio that supplements the existing minimum capital requirements but ignores risk weights. Fourth, increase substantially the capital requirements for the trading book on account of the experience gained during the crisis, especially with illiquid structured credit products. Fifth, create various so-called capital buffers to protect against adverse market conditions and reduce the pro-cyclicality of rules. The mechanics of the capital buffers and the concept of pro-cyclicality will be examined in more detail later. Sixth, encourage the migration of derivatives and related trading to central counterparty platforms, or CCPs, by introducing lower capital charges for counterparty risk for those platforms. Seventh, increased capital requirements for certain securitized investments and impose retention requirements on the seller or originator to diminish conflicts of interest. Eighth, mitigate systemic risk and interconnectedness via higher capital charges for interfinancial sector exposures. And ninth, formalize and standardize liquidity requirements for banks across the world, something we will not discuss in this module, but in a separate module dedicated to bank liquidity. We turn next to the minimum capital requirements imposed by Basel III and summarize these requirements, initially in simplified form, via the table appearing now. All figures appearing in this table are the final figures banks are required to reach by the end of the phase-in period. The most relevant row is the one titled Minimum plus Conservation Buffer, which stipulates a 7% common equity minimum, a Tier 1 capital minimum of 8.5%, and a total capital requirement of 10.5%. The specifics of the conservation buffer will be addressed later, but for now we can think of this 2.5% buffer as an extra layer of capital that sits right above the minimum requirement and whose erosion by losses leads to restrictions on the bank's ability to pay dividends and bonuses. The countercyclical buffer works in similar ways to the conservation buffer, but can be set as low as 0 and as high as 2.5%, as stated here and explained more elaborately a little later. This buffer is intended as a weapon that regulators can use at a national level to slow down banks' lending activities when they appear to have overheated, and to encourage them when they appear to have become too constrained. A final comment is to compare the 7% effective common equity minimum with that of 2% prevailing prior to the financial crisis. In reality, this very low minimum was often exceeded due to pressure from the credit rating agencies, but its replacement with the current 7% requirement shows vividly how much more conservative regulators have become in response to the meltdown of 2007, 8, and 9. Regarding the quality of capital, you will have taken note of the growing reliance on common equity and retained earnings as the main component of capital, in recognition of common equity and retained earnings as the true absorbers of so-called going concern losses, and their ability to provide maximum flexibility regarding the issuing bank's servicing obligations. Basel III clarifies the criteria an instrument must satisfy for inclusion in Tier 1 capital, emphasizing that the instrument must be subordinated, must have fully discretionary non-cumulative coupons or dividends, and must have neither a maturity date nor contain an incentive to redeem, such as a step-up in the coupon or dividend if it is not redeemed by a certain date. Furthermore, any call option the issuing bank has on a Tier 1 instrument must be structured to ensure that the issuer would not exercise it unless it is in its clear economic interest to do so. Finally, Basel III also splits Tier 1 capital into common equity, viewed as the most reliable and loss-absorbing type of capital, and so-called additional going concern capital, sometimes referred to as additional Tier 1 capital. Basel III contains a very detailed definition of common stock, which includes 14 quite tedious criteria enumerated in the rules. The most important of these include that the instrument must have the most subordinated claim in liquidation, and also must be entitled to all residual assets in liquidation in proportion to its share of issued capital after all senior claims have been repaid. That the instrument must be truly perpetual and not subject to any obligation, legal or otherwise, to be repurchased under predefined conditions. That distributions, i.e. dividends, must not be tied or linked to the price at which the instrument was originally issued, nor subject to a cap, and must not be obligatory in any way. In other words, that non-payment of dividends cannot constitute an event of default under the documentation. Finally, that the instrument cannot be guaranteed or secured, nor subject to an arrangement that legally or economically enhances the seniority of its claim. The rules next provide a definition of additional going concern capital, which again contains 14 tedious criteria, but not identical to those for common stock. The most important of these are that 1. The instrument must be subordinated to depositors, general creditors, and subordinated creditors of the bank. 2. The instrument may be callable only after a minimum of 5 years, and then only if replaced with capital of the same or better quality. 3. The instrument must not be secured or guaranteed, and must have no maturity date or incentive to redeem, similar to common stock. 4. The instrument cannot have a so-called credit-sensitive dividend feature, i.e. one which causes the dividend to reset periodically based to any extent on the bank's credit standing. And 5th, and very importantly, the instrument must feature an explicit loss absorption of principal through either a conversion into common shares at an objective pre-specified trigger point, such as a reduction in the bank's capital ratio or its credit rating below a certain point, or alternatively through a write-down mechanism which allocates losses to the instrument at a pre-specified trigger point and reduces the instrument's claim, whether in liquidation or upon any later exercise of a call option. The Basel III rules finally contain a number of minor amendments in the definition of Tier 2 instruments. Specifically, to qualify as Tier 2 capital, an instrument must meet 9 criteria, the most important of which include that 1. The instrument must be subordinated to depositors and general creditors of the bank. 2. The instrument must be neither secured nor covered by the issuer's guarantee or that of a related entity, and must not benefit from any other arrangement that legally or economically enhances the holder's claim vis-à-vis depositors and general bank creditors. 3. The instrument must have a minimum original maturity of 5 years, with its recognition in regulatory capital in the last 5 years before maturity being amortized on a straight-line basis, and must contain no step-ups or other incentives to redeem. 4. The instrument may not be callable at the initiative of the issuer except after a minimum of 5 years. Furthermore, to exercise a call option, a bank must receive prior supervisory approval. The bank must not do anything that creates an expectation that the call will be exercised. And finally, the bank must not exercise a call unless it replaces the called instrument with capital of the same or better quality, and the replacement of this capital is done at conditions which are sustainable for the income capacity of the bank, or the bank demonstrates that its capital position is well above the minimum capital requirements after the call option is exercised. The last important item in the definition of Tier 2 capital is that the holder of the Tier 2 instrument must have no rights to accelerate the repayment of future scheduled payments of coupon or principal, except in bankruptcy or liquidation. We address next the regulatory adjustments to the calculation of regulatory capital, which refers principally to a number of adjustments that must be made to the calculation of Common Equity Tier 1. These are tedious and complex and may be difficult to understand if you do not have a strong accounting background. Specifically, the following items must be deducted from Tier 1 Common Equity: goodwill and most other intangibles, deferred tax assets that rely on the future profitability of the bank for their realization, the amount of cash flow hedge reserve relating to the hedging of items that are not fair valued on the balance sheet. Here, positive amounts are deducted, while negative amounts are added back. Any increase in equity capital resulting from securitization, such as that associated with future margin income. Cumulative gains and losses due to changes in the bank's own credit. Defined benefit pension fund liabilities must be fully recognized in Common Equity Tier 1. investments in the bank's own shares, including any stock which the bank could be contractually obligated to purchase, and mutatis mutandis for additional Tier 1 and for Tier 2 capital instruments. And finally, reciprocal cross-holdings in the capital of banking, financial, and insurance entities. This concludes this chapter 1.